For nearly 3 decades, foreign exchange markets operated under an unwritten consensus. When a major global currency fell into a tailspin, its central bank was left to fight the market forces alone. That unspoken rule vanished overnight when the US Treasury and the Federal Reserve executed a historic, unilateral buying campaign alongside Tokyo to stem the catastrophic collapse of the Japanese yen. It marked Washington's first direct currency intervention in support of an ally since the Asian financial crisis of 1998, transforming what had been a localized economic struggle into a high-stakes display of international financial diplomacy. The turning point arrived after months of relentless pressure on the Japanese currency. Battling persistent inflation and a glaring interest rate gap between Tokyo and Western central banks, the yen had plunged to a four-decade low of nearly 164 to the USD. Household energy bills soared across Japan, imported food costs reached painful peaks, and Tokyo exhausted tens of billions of dollars in solitary intervention to virtually no avail. Facing escalating debt market volatility and an impending economic crisis, Japanese finance officials appealed directly to their American counterparts for structural support. What followed was an extraordinary tactical maneuver that took global trading desks entirely by surprise. In a scene captured at a high-level government gathering, American Treasury Secretary Scott Bessent allowed cameras to glimpse a handwritten list containing an unmistakable directive: buy up to $10 billion in Japanese yen. Hours later, Wall Street primary dealers acting on behalf of the Federal Reserve began making direct, large-scale acquisitions of the yen. In a masterstroke of currency market strategy, the operation was funded by selling off European euro reserves rather than creating new dollars, simultaneously sending shockwaves through European trading hubs while signaling absolute backing for Tokyo. While political leaders framed the joint rescue as an act of international goodwill and enduring alliance, the underlying motives were rooted in deep economic pragmatism. As the single largest foreign holder of American government debt, Japan had begun liquidating massive reserves of US treasuries to fund its own independent currency defense. Left unchecked, that panic selling threatened to spike American borrowing costs and destabilize global bond markets. By stepping in directly, Washington effectively insulated its own financial system while protecting a crucial trading partner from runaway inflation. The immediate impact was swift, sending the yen rallying back toward 155 against the dollar and bringing temporary calm to volatile international markets. Yet, as financial strategists readily observe, market interventions serve as a powerful shield rather than a permanent cure. For the recovery to hold, the long-term responsibility will ultimately rest on monetary policy decisions in Tokyo. Nevertheless, by joining forces in the open market, Washington and Tokyo have written a captivating new chapter in global economics, demonstrating that in an interconnected world, true financial stability remains a shared endeavor.